back. You're still watching The Money Show on ET Now. Let's talk about succession planning. Even Warren Buffett in his annual shareholders letter pointed to it being super important. And let's take that conversation forward with Rajesh Saluja. He's the CEO and MD at ASK Wealth Advisors. Hi, Mr. Saluja, and welcome on board. Mr. Warren Buffett acknowledges entering the urgent zone. Unfortunately, a lot of our viewers don't. They don't have a proper succession plan for their businesses. What is your view on that?
No, I think that's a fact that many clients or many business owners don't have a succession plan. Of course, in the more developed markets, generally children leave their parents and start something of their own. And they follow a different path. But in India, many business or family-owned businesses, the children join the family itself. But most promoters tend to find the topic a little sensitive and don't look at a thorough way of separating family and business. Also creating a proper succession plan in their business, because especially where there are a couple of kids involved or one or two children involved, you find a situation where it's a little sensitive to have a discussion around who should do what. And most of the time we are trying to explain to them why it's important, why they need to separate family wealth and business wealth, why they need to have a proper succession plan on looking at separating management and ownership, and even people who are going to be running the business, having defined KRAs of who will do what kind of a role and how he'll be compensated. So there are lots of sensitive issues which probably need discussion, and many times promoters tend to delay those decisions. And then if something were to happen to the business or to them, it creates a big rift within the family.
But, it's not just businesses. Even for their estates, a lot of individuals, after their passing, their heirs are left grappling with the rigmarole of estate division. So what would you like to say to people in order for them to be able to avoid such a situation?
We've seen a change over the last at least 7-8 years. We are seeing many families actually creating trusts or actually putting wills in place from a purpose of passing on their estate to the next generation. And this has also come about because, when businesses go through ups and downs, and if all the family wealth is in the business, then it creates a problem for the next generation. So people have been thinking about trusts, actually have put trusts in place, family trusts. They've also looked at seeing whether nominations, etc., in place across all financial investments that they've made. So there is this conversation that is going on about the need for it, but many are still in the process of implementing it. But the fact is that if you look at all the disputes that happen in the family, they happen over estate, and it's more to do with either sometimes the will not being in place, or the will being contested even if it is in place, or for the matter, for many families there's no will at all, and there's nothing been clearly defined to say how the assets will move to the next generation. And we've always been advising clients to really take this exercise seriously and have a full-fledged estate plan in place where you can clearly mention who are going to be the beneficiaries, how they'll get the money. And this again is, if you come back to the first answer that I mentioned, it's again a very sensitive topic for many to start having that conversation with children and saying exactly what they will give them. Even from I would say it's a more cultural thing in India. Parents don't want to disclose maybe all the wealth to the next generation, or are not comfortable telling them who will get what. And there are some of those challenges that also exist within the Indian family system. So while there is a trend to now look at creating a proper trust, a family trust or a will for passing on assets to the next generation, but very few have done that, and many are still work in progress.
Mr. Buffett looks at 3 important criteria when he buys a business. To what extent should regular investors apply those 3 criteria?
No, first thing is whether regular retail investors should buy direct equity is a function of whether they have the knowledge, the time, and the research capabilities. So the first advice to retail investors is always to go through professional managers. But assuming that they have the knowledge and research, I think these criteria become even more important. So he talks about businesses where the return on capital is very good. So any business that uses its capital most efficiently. Second is it should be run by competent and honest management teams. And third, you should be able to buy it at a price which is much cheaper than the intrinsic value. Now, if you have the capability to research this and have an understanding of this, then surely you should look at investing with these three criteria. I would also like to add another two criteria that also become important, especially from the Indian context. One is the size of the opportunity in that business. So is it like a small fish in a large pond, and is it in a business where the opportunity is huge? And also the quality of earnings, the consistency, predictability, durability of good quality earnings growth of the company. If it's got stable and consistent earning growth, that also becomes a very, very important aspect to look at in a business. So yes, all these aspects are important. Typically good fund managers and professional fund managers who run mutual funds or portfolio management services do this kind of a homework before they select a business. And if a retail investor wants to invest directly, he should have the capability to do the same.
Mr. Buffett is confident of equities outperforming bonds. How should an individual split their money between the two asset classes?
There's enough and more data that shows equities over a very long term, of course, beat bonds in terms of returns. But it's really a function of the client's investment horizon, his cash flow requirements, his return expectations, and how comfortable he is with a particular asset class. From when we design portfolios or when we look at clients' portfolios, the allocation between equity, fixed income is a combination of all the factors that I mentioned. It starts with what are his return expectations. Number two, how long does he want to stay invested? So if it's short-term money, of course, it will go more towards bonds. But if it's really long-term money, then we always look at equity as an asset class. And then we also try and understand what is the investment experience. I mean, has he seen the value of his portfolio eroded and still been comfortable? Or if there is a erosion in the value of his portfolio, even notionally, will he be comfortable? So all these aspects are important when you sort of create a portfolio. So really the combination between fixed income and equity is a function of each client's requirement rather than a very standard model.
When we talk about Warren Buffett letters, they're usually filled with a lot of important lessons for people. And out of the last few letters, if you could tell us, what were some of the most valuable lessons which you think everybody should follow?
Well, there are lots of lessons, but I think one of the biggest lessons always, and which Warren Buffett talks about, is the power of compounding. And it can be seen from some of the businesses he's held in his portfolio. So he has two types of portfolios, one where he's invested in businesses, and second where he owns a decent part of that company by buying their stock and shares. So in both, it's really, you've seen that he's remained invested. They believe in the power of compounding, which is a great lesson, how the money multiplies over a period of time and is able to take then shocks much later on. Second is the evaluation of business. How do you evaluate a good business? Aspects like which I mentioned even earlier have to be run by competent management. He always believes on that the business should have very good capital efficiency, and he places a huge importance on that. And third, of course, his ability to buy the business at a much cheaper price than intrinsic value. These are great learnings from an investment point of view, whether you are actually investing in a share or you're also actually buying a business. Of course, businesses with moats, which are comparative advantages, has been a big area for him. Then, what he talks about, the temperament of investing, of how, in the short run, you just don't know what's going to happen. We shouldn't get carried away by too much of news or, adverse news that comes from time to time, but remain the course, stay invested with a long-term horizon, and have a good temperament. So temperament is really how you behave during good and bad times, and whether you stay the course or you panic. And I think that in all his newsletters he talks about it. Then also, the other thing that is a big learning is, no matter, he may be the richest man in the world, but his humbleness and humility. Every newsletter he talks about one or two mistakes that he has made, either in investing, or he took a wrong call, or even he missed out certain trends, like how he missed out Apple, Amazon.
Thanks, Mr. Saluja, for joining us. Unfortunately, we'll have to now move away from TMS and cut into the finance minister speaking right now. Okay, she will be speaking very shortly, and we will cut across to that. For now, we'll slip into a break. We'll be back soon.